Today in this video, I'll be talking about this exciting IPO that's coming up, and I'm planning to invest in it with one caveat, and I'll get to that later on in this video. The only reason I found out about this company going public is because of the peak. So if you want to sign up for this newsletter, it's completely free every single morning. It only takes about 5 minutes to read, and it gets you up to speed on Canadian business. You can find the link down below. Again, it's completely free, no obligations to do so, but if you want, it's there. If you guys haven't signed up for Wealthsimple Trade and this is your first time hearing about investing, then you can also check out the other link down below, which will give you $50 for starting investing today. At the end of this video, I'll also be going over what happened in week 28 of my TFSA portfolio. I'll tell you all the stocks that I bought and what my thoughts are in this upcoming week. The reason why I got so excited about this Canadian IPO is basically because of the success of all these other Canadian tech IPOs that have happened recently. These successes include Lightspeed, Docebo, Magna Forensics, and a few others out there. Taking a look at Magna Forensics, they recently IPO'd this past summer, IPO'd at a price of around $17 per share, which I actually got 9 shares of somehow through Questrade IPO Center. And those shares went up rapidly, and today they're trading at $46 per share. At the peak, I think they hit about $60 per share. Another Canadian success story is Lightspeed. I also invested in them around the $34 to $35 mark, not exactly the IPO date, and they went through a rough patch through COVID-19. The stock dropped down to lows of around $14 per share. But if you search up Lightspeed today, they're sitting at $150 per share. That's more than a 10x from the lows of COVID-19 when the stock market crashed. Then we've also got Docebo, and Docebo actually plays in a very similar space to this company that we're talking about today. In Docebo, they IPO'd at $16 per share. Today, they're trading at $103 per share. And it was only about 2 years ago when Docebo IPO'd. Now, I know you've all been dying to hear what company this is and when they're IPOing. So the company I'm talking about today is Desire to Learn. Desire to Learn actually has their headquarters in my current hometown in Waterloo. And they're a company very dear to my heart, and at sometimes we are at odds. Because as a student in the University of Waterloo, we use the Desire to Learn platform, which is called Brightspace. And back then, everyone was trashing on Learn. I saw how Brightspace transformed over my 5 years in university. Originally, it was just a regular website, pretty archaic, and then they transformed all of a sudden to a more modern website, modern looking, and their online web access on mobile phones looked a lot more modern as well. And because of the evolution of the product, they've managed to attract more than half the Canadian universities into using their platform. Currently, they have about 1,000 customers all over the world. 20% of them are international. The rest of the 80% are within Canada as well as the United States. They have about $140 million in recurring revenue. And if we compare D2L to Docebo, they both play in the learning management space. However, Docebo is geared towards more enterprise customers, while D2L is geared more towards educational institutions. But for both these clientele, the pandemic definitely accelerated online learning management systems. People realized how easy it is to deliver online education, and it's a better use of resources. You can shoot once, edit once, and deliver for year over year over year. However, if you're teaching in person, you always have to be present every single year, teaching the exact same lesson with a bit of a twist. And this is ultimately what makes online platforms like YouTube so powerful. You can go back in time 8 years and still watch a video that might be relevant today. And that person didn't have to spend his time again to teach you 8 years in the future. Rather, they just filmed it once, edited it once, and put it online, and you can watch it 8 years later. The last major sticking point for me why I'm interested in D2L is the fact that they're located in Waterloo. And Waterloo is considered the Silicon Valley of Canada. And mainly it's because the University of Waterloo brings so many engineering students in, and a lot of the brightest minds come to Waterloo, not for their education, but really for the co-op program. And that's how they attract the best engineers here. In D2L being local to Waterloo, they also have access to some of the best Canadian talent there is. There is, however, only one con that I can see with D2L right now, is the revenue growth is predicted to grow about 20% year over year. And if you look at the other companies that are in the online education space, they're growing at 40% rates, 60% rates, and 70% rates year over year. So either D2L is sandbagging their growth rates, or there's something a little bit fishy about the business. They haven't yet released a prospectus, so when that comes out, I'll definitely be taking a look at it before doing my investment decision into this company. Now, the one thing that could turn me away from D2L is the PS ratio. And let's jump over to my computer to look at some of their competitors, and I'll show you what I mean. So some of their closest competitors, Docebo here, has a PS ratio of 33.32. However, I won't be using this number as a gauge for if I'm buying D2L or not. And the main reason is Docebo has a different clientele. They are catered towards enterprise, while D2L is catered towards educational institutions. I would say Coursera is a bit of a closer competitor. Looking at their price to sales ratio, it's 13.3. So we can see that investors right now are valuing Docebo at a higher PS ratio because they expect it to grow a lot larger. And I think mainly it's because enterprises have a lot more money, and as well as there's more enterprises out there in the world. So they have a larger total addressable market compared to companies like Coursera or D2L, which are targeting schools or universities, and these are typically government funded and not really geared towards like hyper growth or profits. Now, if we turn over to some other companies that are playing in the learning management space or online learning space, PowerSchool Holdings is a company that I found. And this is actually from the article talking about D2L's going public. They listed PowerSchool Holdings and Instructure Holdings as some of their competitors. So PowerSchool Holdings has a price of sales of 10.59. So in the similar ballpark as Coursera. And then we've got Instructure Holdings, which has a price to sales ratio of 8.57. And I know that Instructure Holdings has a product called Canvas, which is a direct competitor of D2L's Brightspace. So I'd be looking at D2L, if I were to buy into it, I'd be hoping the price to sales ratio is between an 8.5 and maybe an 11 I could give them. Now, seeing that the revenue is at $140 million USD, and they're planning to go IPO for just over $1 billion USD, then that would actually put them at a PS ratio below 10. Now, I'd be willing to pay up to a valuation of around $1.4 billion, but if it goes over that, then I think there's just a lot of IPO hype, and I might be waiting for the stock to cool down a bit. That also could mean that I'm giving up the opportunity of having it spring up like Docebo if for some reason Canadian investors believe that D2L is an amazing tech stock and they bid it up to a price to sales ratio closer to what Docebo is at 33.32. Or even Magnet Forensics, which is another Canadian tech stock, which I didn't think could command a price to sales ratio of 34.43. However, it managed to do that with a very small total addressable market. And if we go to the other success story, Lightspeed, they're commanding a price to sales ratio of 72.55. So that's double Docebo's as well as Magnet Forensics. I mean, at this point, it almost seems like the sky's the limit of what investors are willing to pay for Canadian tech companies. But as a smart investor, we have to go in knowing what we're willing to pay and not allowing ourselves to be bid up on that original purchase price that we've made. Otherwise, we could run into FOMO and end up sometime down the road having some major correction and waiting years before the stock recovers. If you're interested in reading more about D2L going public, then I'll leave the link to this article down below. Now let's hop over to my TFSA portfolio and talk about what happened in week 28. Starting off the week on election day, September 20th, I deposited $200 into this account. On the very same day, I bought one share of TD at $81.75. I also use a fractional share option in Wealthsimple Trade to buy a portion of a share of Shopify. I spent $24.85 on that share and bought that. The next day, I had a limit order fill where I paid 98 cents per share for 30 shares of DCM. And the last thing that I did this week was to buy one share of Dollarama at $56.61. Over here on my activities page on the Wealthsimple Trade app, you can see that I had two limit buys for Sun Life. They're at $63.80, both of them. However, neither of them have filled. I've also got a limit buy set up for DCM that I set on September 15th, looking to buy 20 shares at 95 cents per share. Currently, that limit buy is still in action, so if DCM does fall to 95 cents per share, you'll be sure that this order will be fulfilling. Now, going over the portfolio metrics, my portfolio is currently worth $7,644, and I'm up 2.67% since I started this, or an equivalent dollar amount, $198. The TSX, if I bought or put all my money into the TSX since March 16th, I would have been up 7.53%. However, as you guys know, I've been dollar cost averaging into this portfolio every single week, depositing $200. I do think that it's very possible for many people to be depositing $200 per week. However, if you're not able to do that, at least start with like $50 or $100 per week. It's better to start somewhere than nowhere. I know that there's some people out there who could even deposit $1,000 per week. For me, I've just said it that I'm doing $200 per week, and that's what I'm sticking to. And so far, this is week 28, and I've stuck to that every single week. If we compare my portfolio to the index, so every time that I bought a stock, I compare it to if I were to buy the index instead. Currently, my stock choices are down by 1.77%. There was a point in time, maybe 3 or 4 weeks ago, where I was up by 2%. And then also, if you go back to the early days of this portfolio, about week 10 or week 11, I was down around like 5 or 6% compared to the index. So this portfolio does fluctuate a fair amount compared to the index. If we zoom into all the different positions I have, you can see the percentage return or loss that I have on all my positions. The ones in red are negative returns, and the ones in green I have a positive return on. I've also drawn out the 1 week performance so that you can see how the stock performed in this week alone. So DCM was my biggest winner this week, going up by 9.18%. In me buying the shares at 98 cents per share, we can see they ended up on the week around $1.07. So I was roughly up 10% on my purchase of DCM this week. However, overall, I'm still down about 9.17%. And if you guys have been following my channel, you know that I'm not worried about the stock, and this is a company that I'm planning to hold for at least 3+ years. I mean, if the stock shoots to $10, then I might consider selling. However, I think that's fairly unrealistic unless we go into some huge bull run. So in the meantime, I'll be continuing to buy more of DCM as long as it stays around the $1 range. Other notable gainers this week was Air Canada. It was up by 3.25%. This week I didn't purchase any Air Canada stock. However, next week I may consider. In the $23 range, it's trading about $2 lower than my cost basis. And I've been continually bringing down this cost basis ever since I started my position at around $26, $27 per share. Power Corp Canada is one that I'm actually interested in this week because recently it was sitting around $43 and now it's come back down to $41. If we see another negative week for this company, I will be picking up more shares if it goes to the lower 41 or even drops to $40 per share. I've mentioned before, the net asset value is about $50 per share if you add up all the different assets that they own and divide it by the number of shares. So this company is undervalued by about 20% right now. You guys saw earlier that I bought a share of TD Bank, and that's because, again, it's below my cost basis. With Justin Trudeau being elected and that 3% tax that he promised on insurance companies as well as banks, I'm not really worried about that because at the end of the day, these companies will end up passing that cost on to consumers. I know that's going to suck. However, everyone in Canada right now kind of needs a bank, and there's no other real alternatives for people. I mean, there are, but they're a little bit more inconvenient. We can see from their stock chart they've actually been on a bit of a decline. They peaked around $86 or $87 per share just a couple months ago. However, they got beat down just a little bit, and they're actually doing worse than most banks out there right now. But as the stock price continues to fall, their dividend yield goes up. And right now, they give a juicy dividend of 3.8%. Another company that I'm looking to pick up more shares on this week is Well Health Technologies. And I haven't been buying Well Health because it's been bouncing around $7.50 and around $7.20. My personal price target for Well Health Technologies right now to pick up more shares is around the $7.10 range to $7.20. I think that's a fairly decent value, as well as there's good support for Well Health in that area. Going over to the stock chart, looking at the 1 year, every time they dip to about the low $7 or even high $6, you can see there's always been a bounce back. So to me, that indicates that there's solid support at around the low $7 range. If it drops to $7.10, I might buy like 7 or 8 shares. And then if it drops even below that, I'll continue buying more shares in the week. Another thing that I want to highlight about Well Health Technologies is that they were included in the TSX Composite Index on September 20th, and that's election day. In the following 2 days, the stock price went up. However, now the stock price has dropped back down below the price that it was trading on the day that it was introduced into the composite index. So the composite index didn't really have any impact on Well Health Technologies and the stock price. Yes, it did bring in some buyers. However, there are probably some long-term holders out there who are like, let's take this time to capitalize on Well Health being in the index and selling off some of my shares. So that's probably what happened when Well Health was introduced to that index. The last stock that I plan to buy next week is Shopify. Shopify has been kind of petering around the 1950 stock price to around 1850s. Right now it is trading at 1828, below my cost basis of around 1858. So if Shopify trades around the 1800s to about 1850s by the end of a certain day this coming week, be sure that I'll be putting in a fractional order about $25 worth of Shopify those days. And I do believe in Shopify long term, which I mentioned in my previous video. And that's just because Shopify's got such a great ecosystem, and the customers who use the Shopify platform depend on Shopify for the business to thrive. So Shopify, in my opinion, is still a relatively small company in the grand scheme of things. They actually recently released an article that Shopify got more click traffic versus Amazon. And this is kind of showing the power of Shopify in today's e-commerce culture. I'm still on the lookout for more new stocks, so let me know down below what stocks you guys are buying, because right now I can't really seem to find that much value in the market. I've been scouring left, right, and center, but nothing really has caught my attention. If you enjoyed this video, remember to leave a like down below, as well as subscribe and hit that notification bell if you're new here. I'll be throwing a video up on the screen over here talking about my other portfolio, which is worth around $44,000 or $45,000 today. You can check that out. I haven't made an update video on that portfolio yet, but be sure that will be coming out soon. Maybe this week, maybe next week, but depends on my schedule. If you're there, I'll see you there. If not, keep up the grind and have a great day.